It was Benjamin Franklin who famously said nothing in life is certain apart from death and taxes, but it seems this is a fallacy for those corporations operating in the United Kingdom. The reasoning behind this is due in large to Her Majesty's Treasury. Headed by the Chancellor of the Exchequer George Osborne, it is tasked as an institution with various missions, including the strategic oversight of the UK tax system. The Treasury does this through Her Majesty's Revenue and Customs, HMRC. The problem with HMRC in regard to the British corporate tax system is that it is institutionally corrupt. During the 2012 tax year, the British tax gap, the difference between taxes owed and taxes collected, grew by 7% to a staggering £35 billion, or half of the UK current account deficit. Over 10% of this came from corporate tax avoidance. It's important to note here the difference between tax evasion and avoidance. Tax evasion is the process of illegally reducing the amount of tax you owe, whereas tax avoidance is not technically illegal, but it refers to the gaming of the system to reduce your tax burden. But what does this have to do with HMRC? Well, this corporate tax avoidance is a product of the corruption of the institution. This is due to the fact that HMRC rely on the advice of tax experts from 4 of the largest accounting firms in London: Deloitte, KPMG, Ernst & Young and PricewaterhouseCoopers. These experts are brought in to consult on changes that should be made to the tax system, but then return straight back through the revolving door to their private firms, where they provide advice for corporations on how to exploit tax loopholes. This is clearly a horrendous conflict of interest, which draws parallels with the issues of financial market and pharmaceutical industry regulation. In a report to Parliament, the Independent Public Accounts Committee stated that the big accountancy firms are increasingly seen as being part of the problem with corporate tax avoidance rather than the solution. The government is reliant upon this type of consultancy. Britain's tax code is so complex, it relies upon the 9,000 staff these firms employ for the task to keep it up to date, or not so, a number that dwarfs HMRC's manpower and is so high that the government could never afford to employ such a number. There have been calls for one very basic solution: simplify Britain's tax code so that it can be far more easily understood. And yet, despite claiming on their website to be working to prevent, detect and counteract tax avoidance, the Office for Tax Simplification employs just 6 people. This is, I believe, due to an external influence acting on the purpose of HMRC. HMRC states that its purpose is to collect taxes due from all taxpayers without fear of favour. However, with the recent economic downturn, the MPs of the Public Accounts Commission accused HMRC of being unhealthily cosy with big business in an attempt to attract investment into the country. This influence is diverting HMRC away from its true purpose, and so from this disturbance of the compass and blatant conflict of interest, it's clear to see how the Treasury and HMRC fit our definition of institutional corruption. All this has led to an undermining of the public's trust in the ability of HMRC to enforce tax law, lending further weight to the analysis. In the 2013 YouGov poll, 62% of Britons surveyed thought tax avoidance was unacceptable, and you only have to take a look at some of the headlines from Britain's major newspapers to see the same result. So what can be done? There is one interesting solution that attempts to affect the way in which corporations interact with the accounting firms, through the way in which consumers interact with the corporations in turn. This solution looks at how we can change social norms to incentivize tax compliance through a public naming and shaming. Jasmine Fisher discusses this approach in her article on tax avoidance titled Fairer Shores, concluding that it has had little success, but there is, however, a reason why it chose Starbucks. In 2012, the company was turned on its head when it, along with a number of other well-known companies, was publicly shamed about their tax avoidance in British press. It was reported that since their opening in 1998, Starbucks had only paid £8.6 million in corporate tax on over £3 billion of revenue through a system of global profit reallocation. Their buzz score, the number of positive social media hits versus negative social media hits, plummeted to minus 43, and on the 22nd of June, nearly 30% of social media users have been exposed to the brand, with top words mentioned alongside Starbucks being tax corporation in UK. The police even had to be brought in to protect shops against protests. Starbucks quickly responded to try to control the damage, immediately announcing that they would pay £10 million in tax by the end of that year and a further £10 million by the end of 2014. Crucially, due to their methods of tax avoidance, this was a voluntary payment. The downturn in public opinion was therefore enough to incentivize the company to pay. Interestingly, however, it seems that even this was not enough. Just last Friday, it was announced that Starbucks UK revenue had fallen for the first time in its history by not an insubstantial 3.4%. This appears to be a perfect solution then. The changing of social norms in regard to the negative backlash seems to have incentivized Starbucks to pay corporation tax in an effort to boost their public image. It is, however, imperfect. For one, there is no direct correlation between the tax avoidance scandal and Starbucks' drop in revenue, and other companies such as Google and Amazon, who were also shamed, experienced no such drop in their revenues. Starbucks is differentiated, however, by the fact they provide a common service in a highly competitive market, and this distinction lends hope to the fact that by changing social norms, we can change tax avoidance to tax compliance, thus removing the conflict of interest between the government and accounting firms and alleviating the effects of institutional corruption.